E. Distinguish between individual security risk and portfolio risk. Individual security risk reflects the total variability of returns for a single investment. It includes both systematic, market-related risk and unsystematic, company-specific risk. When analyzed alone, a security may appear highly volatile due to firm-level factors. Portfolio risk measures the variability of returns for a collection of investments. Unlike individual risk, portfolio risk depends not only on each asset's volatility, but also on the correlation between assets. Unsystematic risk can be diversified away within a portfolio. Therefore, well-diversified portfolios primarily reflect systematic risk. Investors are compensated only for systematic risk. Company-specific risk can be reduced through diversification and does not command additional return in efficient markets. Understanding this distinction improves asset allocation and capital budgeting decisions. F. Demonstrate an understanding of diversification. Diversification reduces overall portfolio risk by combining assets that do not move perfectly together. When returns are imperfectly correlated, negative or offsetting movements stabilize total portfolio performance. The benefit of diversification increases as correlation between assets decreases. Assets with low or negative correlation provide the greatest risk reduction. Diversification eliminates unsystematic risk, but not systematic risk. Market-wide factors continue to influence all securities to some extent. A well-diversified portfolio requires a sufficient number of securities across industries or regions. Concentrated portfolios remain exposed to company-specific shocks. Effective diversification improves the risk-return trade-off without necessarily reducing expected return, enhancing overall portfolio efficiency. G. Define beta and explain how a change in beta impacts a security's price. Beta measures a security's sensitivity to movements in the overall market. A beta of 1.0 indicates the security moves in line with the market. Greater than 1.0 implies higher volatility. Less than 1.0 indicates lower volatility. Higher beta implies greater systematic risk. Investors require higher expected returns to compensate for this increased risk exposure. If a security's beta increases, its required rate of return rises. Holding expected cash flows constant, a higher required return reduces the present value, lowering the security's price. Conversely, a decrease in beta lowers required return and increases price. Beta is central to pricing risk in capital markets and evaluating investment performance. H. Demonstrate understanding of CAPM and calculate expected risk-adjusted returns. The Capital Asset Pricing Model, CAPM, calculates expected return as expected return equals risk-free rate plus beta times market return, risk-free rate. The model links systematic risk to required return. Only market-related risk, beta, is priced. Unsystematic risk is not compensated. The risk-free rate represents the baseline return with no risk. The market risk premium reflects additional return demanded for overall market risk. CAPM is widely used to estimate cost of equity in capital budgeting and valuation. It provides a benchmark for assessing whether a security is under or overvalued. Understanding CAPM enables candidates to evaluate risk-adjusted performance and make informed investment decisions.